Hello, folks. I'm back here with a new series. Here we'll cover some order flow and footprint strategies. So, the first series, which we did, series one, two, three, we covered the basics of footprint, the strategies, the why it happens, and then also sort of building the footprint charts, etc. Thank you so much for the feedback that I had for the videos. It was overwhelming in terms of response, and a lot of you guys left very nice notes. And I'm so happy that a lot of you guys have been trying to use those strategies and have been active in terms of communicating around the applications, etc. So taking this forward, we'll cover a new strategy today. We'll cover a strategy essentially. So we've not done the strategy part so far. We'll cover a strategy, absorption and footprint trading. Okay, why absorption? Because I feel this is one of the easier strategies in terms of sort of interpreting, reading in the markets from a footprint and order flow point of view, and hence it's easy to sort of track and follow and execute if you're getting started with footprint and order flow trading, and it's effective as well. So it's not that it's easy but not effective, but it's effective as well. Okay, so the reason being is the reason being for that is absorption essentially happens over a period of time. It's not a one candle single tick event essentially. So it happens over a period of time in the market, and it's across a few candles, across a multiple candles. So you have a lot of time to sort of interpret, read, and react to it. Generally, it doesn't require that fast an action compared to a lot of other footprint strategies. So that way, it's easier to read and execute. Okay, what we'll cover is what is absorption, what is the background, why does it happen, what, and etc. And then eventually into some execution strategy and key points to observe while executing the strategy. So to start with, what is absorption? Absorption essentially is absorption. So it means something is getting absorbed. In this case, uh, what we're seeing is aggressive buyers or aggressive sellers, which is market buyers or sellers, are getting absorbed by limit buyers or sellers. Okay, so market buyers, in terms of an uptrend, if you see market buyers are getting absorbed by, market buyers are getting absorbed by limit sellers. In terms of a downtrend, market sellers are getting absorbed by limit buyers. Okay, so let's see how it shows up. Okay, let's see how it shows up. So first would be in an uptrend. So let's say price is generally going in an uptrend here. Okay, so it makes a new high and then it pauses or makes a lower high. Okay, so price is not making a new high, but let's say your delta continues to make a new high, right? Delta continues to, so it's a high, new high, but price sort of is not making a new high. So that is where you see a bit of a delta divergence. The reason being is more buying has come in, but it has not led to an increase in price. Okay, so that is where an uptrend is getting absorbed here, absorbed at these levels, right? And that is your sign of absorption on an uptrend. Similarly, on a downtrend, okay. So let's say market is going down, and it tends to pause at some point, right? It tends to pause. But let's say in your delta, it is not pausing; it's further going down. So the delta continues to make a new low, but price stops and pauses and is not making a new low. Okay, so what is happening is, again, price is sellers are coming in, but they are selling into limit sell orders here at these levels, right? So sellers are getting absorbed. Sellers are getting absorbed in a downtrend. In an uptrend, buyers are getting absorbed. Okay, and that is absorption in a sense. Okay, in terms of how it will look like in a price or a candlestick chart. Next is why it happens. Okay, next is sort of why it happens. Okay, in the market, we generally have, as I said, in the series 2 we cover these. We have two types of player. There's a limit sell order players and there's a limit buy order players. Okay, we were known as passive guys, and then there are aggressive guys. You know, uh, uh, then there are aggressive guys who are sort of market sell orders and market buy orders, known active or aggressive guys. Okay, so let's say price is going on an uptrend in this case, and we have a limit seller here at this price point. So any new buying coming in is absorbing. Okay, in this case, and this guy probably in this case, in the case of absorption, is bigger than the market buyer order. So he's absorbing everything, and hence, despite new aggressive buying coming in at different price points, price doesn't agree to go up. Okay, price is not going up because the seller is big here. Okay, and he's waiting at this level and he's selling into everything that is coming in. Eventually, the buyers are finished. There's no more buyers left in the market, so market will sort of turn back around, and that's absorption for you essentially. So, in case of an uptrend, your limit sellers in case of an uptrend, your limit sellers are greater than your market buyers. In case of a downtrend, your limit buyers, which is waiting there at buy levels, let's say, are greater than your market sellers. Okay, so they're absorbing the prices. Now, why this happens? Okay, we'll run through a very simplistic illustration of sort of why it and how it happens and how it shows up, and you'll understand what happens. So let's say market is trading at a price, let's say close to 15,000, NIFTY prices, let's say. Okay, now let's say at this point in the day your delta is showing at 4,000. Okay, what we have here is one big limit sell order here, guy who's sitting with, let's say, 10,000 limit sell orders at 15,000. He wants to defend his price. Okay, so he's there. Okay, and X comes in. X thinks market is breaking out today, it will go up, break through 15,000, make a new high, etc. And he decides to come in and buy 2k orders, 2,000 quantity, let's say NIFTY. Okay, so he does a market order 2,000 because he wants to participate and he wants to buy into that move. Now what happens is, your cumulative delta becomes 4,000 plus 2,000, it becomes 6,000. Okay, and so he's bought 2,000 to this guy, from this guy who was selling, right, at A. So now he has 8,000 still left, but X is done. He's bought what he has got to buy in the market, right? Okay, so X is absorbed. Now this is 2. Now let's say again, after a point of time, Y comes in. Y says, he thinks, okay, breakout is going to happen, has a similar outlook that market will go up, and he decides to buy another 2,000 here. Okay, so what we see is, cumulative delta goes to up by 6,000 plus 2,000, 8,000. And he sold into whom? He sold into this guy again, who's still sitting at 15,000. So he, so 2,000 is sold. He still got 6,000 quantities left to sell, but the buyers are done, right? So X is done, Y is done. Now let's say no more buyers are remaining, right? So eventually, market will pause and then tend to turn back. Okay, this is a very simplistic illustration, but this is why absorption happens and how it happens over a period of time. So what is happening is delta, if you see in the, delta is up, delta goes further up, delta goes further up, but price is static at this level. Price is not moving up, while cumulative delta is keep on increasing for a period of time. Okay. So I'll have this simple illustration, a very simple price chart of oil. This is happening. You see over, let's say, over this block. If you see over this block, okay, your delta in this case, this is a cumulative delta. So it was 537 to start with. Okay, it keeps on increasing. This positive delta, positive delta, positive delta, positive delta, positive delta. Okay, but if you see price, okay, price is just static, price is not moving, price is just exactly at this level. So cumulative delta increase from 480, 530 to 770, but it has not led to any price increase. Price just is there, right? So eventually, you know everything is absorbed, price doesn't move, buyers are done, and then the downward starts. Okay, so that's the absorption strategy. Absorption is a very good counter trend strategy in terms of trying to play trend reversal with a very low risk, because what you will all have to do is sort of you have very small stops and you could participate in a counter trend strategy. Okay, now when do you participate and how do you participate, right? Okay, generally, as I said, if you know it's a counter trend strategy. So in an up move, let's say price is going up and you have this absorption where price has not moved, but you have delta which is moved higher, right? Okay, so I typically wait for price to break that little swing low, pivot low, or anything, and then you have your stops above the recent highs, that's all, and then you look for a pullback to any other level. It could be the VWAP, it could be your any other previous support or resistance level is what you trade a pullback for. So the risk reward is very favorable. You have a very small risk, which is the recent high or low. Okay, similarly, in case of a, let's say, downtrend, your price is making a new downtrend, and then price is pausing. Okay, so you'd probably look for a break above this region. Okay, and a recent any recent low or any recent high here, essentially swing high, and a break above that, and your stop should just be this. Okay, so you target back to any mean reversion level for that day. It could be support level, pivot level, EOF, etc. Okay, so the risk is low. So what are the key points around absorption? Quick points here. One, it is fit across any time frame, so you could absorb, you could watch absorption in a 5-minute chart, 30-minute chart, or even any chart that you feel like. So the patterns are similar, the strategies are similar. Okay, so as I said, it is over a period of time. So you have one candle, two, three, multiple candles which are getting formed. Price is not moving up. So you have a time window to absorb, sort of observe the absorption and then play reaction to it. So it's not a one candle event. So you do have a time window to absorb it. Okay, and then if you see break of the candle as the entry pattern, so break of any recent low, it will be your entry area. So your entry could be recent swing lows, or you could start taking aggressive entries when you see absorption happening and delta come, you see delta increasing but price is not increasing, or price is remaining static. You can take aggressive entries with to preemptive, or you could take preemptive entries essentially with more risk, or you could wait for a swing low to recent candlestick low. For example, if it is forming this, and then it is this, and so again price is this, so you could wait for a break of this low to enter alternatively. Okay, and that is one thing. So and your stops is again here. Now, sometimes price would sort of form a same high or a little higher high, but delta forms a way higher high. So sometimes this is exactly not followed by the book. So what I do is I do watch for a relative change of delta versus price. Okay, so if price, let's say delta has doubled. Okay, but price has only moved 5 points or 10 points on the upside, or not moved at all or remained flattish. So you could also observe a relative change instead of a absolute, price making a lower high and delta making a higher high sort of a pattern. Okay, and the other important thing is to combine with other support resistance levels. For example, your pivot support resistance, previous highs. If you're following volume profile, then profile highs, lows in areas, it is important to combine with those levels, and the probability of results and profitability is increases. So that's another input. So not for not to look for absorption across any price point, but try to look at for previous support resistances, etc., and then see if absorption is coming in at those places. So you have a higher probability of win if you're doing that. So not trying to get into an absorption trade at any price level, right? So combine it with your resistance level areas, and you have a beautiful setup in place. Generally, I've seen you do get almost one play a day or even sometimes more, but there's a high probability play that it happens on a very regular basis across any liquid market. So it's a good strategy to trade low risk, counter trend, and also sometimes I use it for exiting my positions. For example, I'm short in the market, but now I'm seeing that why price is static, but delta keeps on increasing. So I'm assuming that while delta is decreasing, price is not decreasing. That means it is getting absorbed. That means the buyers are big here, right? The buyers are big here. Let's say I have a short position from here, so I would either place a very tight stop, or I would just exit at this position and wait for a new pattern to form. So sometimes it gives you a better exit than to wait for a pullback and then have a trailing stop loss hit or something like that. Okay, so sometimes you could use it to exit your positions as well, which is the benefit of it. Okay, I think that's about it. Thank you. Thank you. Try observing it over the market for few candles. Try observing it on some recent historical charts. You'll find some patterns. So that will be useful for practicing. Okay. Thank you so much. Have a good weekend.